Hello everyone, my name is Soo Fang. I'm with the Asian Equities team at UOB Asset Management. Before I proceed to the outlook for REITs, allow me to actually briefly introduce REITs as an investment tool. So why should we invest in APAC REITs? There are 3 reasons for that. The APAC REIT class has actually proven to be able to offer stable returns, and I will talk more about that later. Secondly, it is a good diversification tool for one to actually add to your existing investment portfolio aside from your typical equities and bond allocation. So even though REITs is part of equities, it has very bond-like characteristics, and that actually render it more defensive against other asset classes. And thirdly, the APAC region is currently in different phases of economic recovery from COVID, and REITs is actually well positioned to benefit from the reopening. So how does a REIT grow? A REIT typically grows by acquiring real estate property types to actually expand its portfolio, and this coupled with rental growth would translate to higher rents and ultimately will be higher dividends to the shareholders. So in addition to the regular dividends, a REIT also offers potential upside from capital appreciation as real estate assets are revalued either through rising land prices or asset enhancements undertaken to boost the value of the property. This chart shows the performance of APAC REITs as highlighted in red versus the broader equity market. Over the long term, the APAC REITs actually outperform the broader equity markets, delivering an annual return of 7.7% per annum versus 5% for your broader markets. And here we see a large part of the REIT's total returns is largely due to dividends, which is denoted by the shaded blue part. And that's because REITs are actually required to distribute a minimum of 90% of its distributable income as dividends per annum. And more importantly, these dividends are actually backed by your rental paid by your tenants to the property owners. Now that we have a good understanding of the REIT asset class, let us briefly take a look at how APAC REITs is performing. So if we take a step back and look at 2021, it was a good year for REITs globally, and clearly US and UK did very well, whereas in Asia itself, the Japanese REITs as well as the Australian REITs fared much better compared to the peers in the region. For this year itself, it has been quite a tough start, and you can see over here, APAC REITs as represented over here is down some 14% year to date. Despite this, it actually outperformed the broader equities market. And we would say that this correction in the markets is largely due to the prospects of central banks lifting interest rates as well as the associated long bond yields. And what's dragging down performance is actually very weak Australian market, whereas your Singapore REITs and Japanese REITs have been relatively more resilient. And the current pullback in APAC REITs, as represented by the red line, is consistent with the past episodes of volatility. And this is because the market is preparing for an interest rate lift-off. The US Treasury bond yield, which is the blue line, is inversely correlated to the REIT's performance, although we note that this relationship has loosened somewhat over time. And year to date, the monetary policies of central banks have been more hawkish than expected, as led by the US Federal Reserve. As such, we actually see the US interest rate as a suitable leading indicator to get a sense of where the REIT market and how it will perform in this current market environment. So what is priced in and what can we expect going forward? And while interest rate as well as inflation expectations have escalated since the start of this year, we do expect that the inflationary pressures would actually taper off, and hence the interest rate hikes would actually be more moderate. And in the event that we actually have an adverse scenario where we see demand destruction from inflation, we expect the central banks to actually ease its monetary policies again. So what does this mean for REITs? What this suggests is that we should see share prices consolidate in the near term. And a key watch point that we're actually monitoring very closely is the peaking of expectation of interest rate hikes. The performance of S-REITs during past interest rate hike cycles, and this sector actually corrected by about 11 to 17%. And year to date, S-REIT is actually sideways in a trading band and currently trades 10% below its previous peak in November 2021. So if we use 2017 and 18 as a reference point, this would suggest that there is a limited downside risk from current level. Is it then a good time to actually buy? So APAC REITs currently trades near 1 standard deviation below mean on a yield spread basis, and it is not cheap. This is actually in line with past periods of late cycle growth, and the average sector dividend yield of 4.3% is still fairly decent. Separately, if we look at valuation on a price-to-book basis, this is supportive. If you look at the APAC REIT sector, this has actually derated 18% from its peak, as you can see on the red line, while valuation level has actually turned attractive. As such, we actually see this current opportunity as a good time to actually position and diversify into the sector. Our analysis show that past precedents suggest that the sector typically perform well after the initial rate hike. So where are the investment opportunities? And for that, let us now take a more detailed look at which REITs and subsegments which would be more resilient in this current market environment. So this is a property clock which represents our snapshot of the outlook of the sub-segments across different markets in the APAC region. We have a bullish view on industrial REITs given continued tight demand and supply across the APAC markets, as they are currently in the peaking stage as shown on the top left quadrant. So in the peaking stage, we normally see capital values and rents rising at a slower pace. Your rental growth may be plateauing, and there's a widening stock discount to NAV. Now you may notice most of the sub-segments of other REITs are actually concentrated in the bottom right quadrant. In the bottoming stage, the typical characteristics are your capital values and rents would actually decline at a slower rate, your vacancy rates begin to peak, and valuation discount begins to narrow. So we are positive on retail REITs, as this sector is actually well on the recovery path and should see reduced rental waivers, while hospitality REITs is expected to see a strong earnings rebound for the next 2 years. We're fairly neutral on office REITs across APAC in general, except for Singapore office REITs due to the limited supply. All in all, we expect APAC REITs to actually grow DPU by about 4.3% per annum on average for the next 2 years. And most of this growth would largely be front-loaded before it moderates to about 3% at a more sustainable growth rate next year. Industrial REITs has been one of the key beneficiaries of COVID, and we expect this sector to actually continue to perform. Operating metrics remain strong and underlying demand is still intact. In Singapore itself, the warehouses is the most robust, and warehouse leasing demand, especially for prime logistics, remains strong. And what's driving this demand is actually your third-party logistics, your biomedical industry, as well as your e-commerce players. As for business parks, they should enjoy positive growth given muted new supply. Where we are a little bit more cautious is the flatted factory segment due to the upcoming supply in the next few years, as you can see on the chart on the far right. And over here, these charts show the Japanese industrial REIT. You can see similar supply and demand dynamics in key cities of metropolitan Tokyo as well as Osaka. We expect rental upcycle to actually continue given low vacancies for modern logistics. As you can see here, vacancies are fairly tight at about 2 to 3%. Likewise, there is a shortage of new industrial space in Australia. Vacancies are sub 2% across cities like your Sydney, Melbourne, and Perth, and this has actually led to rental growth rising by high teens. The office segment is a largely two-tier market, and we expect a faster than expected rebound in the downtown and CBD Grade A office rents, and this is largely due to the continued flight to quality trend. Demand for new office space is mainly coming from tenants looking to upgrade, especially in Japan and Hong Kong, as well as new entrants mainly from tech and MNCs. Now we have a neutral view on office REITs in general due to the long-term overhang from flexible work arrangements. That said, we are fairly upbeat on office as REITs given muted supply. And just to give you a sense, the upcoming new supply for the next 3 years is actually 30% lower compared to the last 10 years. So in Singapore, the new sizable office space is coming from GoCo Midtown, which is expected to be completed end of this year, as well as Central Boulevard Towers, which is expected to come on board in 2023. So leasing demand in Gokul Midtown has been strong based on our channel checks, and we understand that two tech firms are looking to occupy some 20 to 30% of the space at Central Boulevard Towers. So while office rents is fast and furious in Singapore, the picture is however less rosy elsewhere. The outlook is a bit muted for Japan office sector in the near term, given that there is an expected excess of supply coming on board in the next few years. Vacancy rates have actually stabilized at about 7%, but we think that the rental rates will continue to remain pressured. So that said, our preference for Japanese REITs in the office sector is for smaller size office buildings, as corporates actually continue to downsize their needs for office space. Over in Hong Kong itself, the outlook for office space is subdued, largely due to the weak leasing foreign demand, on top of ample new supply expected to come on board. Nevertheless, we like Grade A office properties, notably the ones in central area, as the flight to quality trend is quite pronounced in Hong Kong itself. And we also see the resumption of Chinese corporate leasing activities to actually catalyze the sector. And in Australia itself, the office market is, although not as robust as Singapore, it is still relatively more encouraging compared to the rest of the markets. As you can see on the chart on the left, office vacancies in Sydney and Melbourne had actually flattened, while the chart on the right shows that the subleasing space is actually gradually falling. So this in totality should actually support rental outlook, and we should see some gradual improvement as we head towards next year. And in Australia itself, we think Sydney should outperform Melbourne, given that they've actually had a higher proportion of new supply which has already been pre-committed. We have a constructive view on retail REITs. This sector, even though it faces structural headwinds from e-commerce, we think, brick and mortar at the end of the day is still relevant. Retail malls have been repositioning itself to remain relevant by offering a more experiential experience to the shoppers, and this has actually allowed them to actually attract more foot traffic. So the retail sales is seeing a firmer recovery. We are seeing rental waivers or concessions actually abating. Rents had actually bottomed, and occupancies remain high as new entrants actually outweigh exits. And while the foot traffic has not quite recovered back to pre-COVID level, tenant sales at some malls had actually surpassed pre-COVID level. So in the near term, we see more upside for downtown or CBD retail malls, as they could actually outperform as more workers return to office. So in Singapore itself, there is a limited supply of new retail space, especially in prime Orchard area. Market rents, as shown on the chart on the left, is actually showing stabilization, while operating metrics is gradually improving. Here we see more upside for downtown and CBD retail malls. More workers actually return to office in Singapore. And in Australia, supply pipeline is moderate, as you can see on the chart on the left, and most of this supply is actually coming to the market towards the mid or end of next year. And if you look at the right charts, this chart shows you the rental growth by retail formats. As such, we prefer suburban malls, i.e. your neighborhood or large format retail malls, as they continue to show more resilience. In Hong Kong itself, the retail industry continues to be supported by strong domestic consumption, and we believe that the worst is actually over for this sector, even though the recovery is likely to be a very long one. If we look at the chart on the right, what is clearly missing is the return of Chinese tourists, which is the part shaded in dark blue. So this underscores our preference for suburban malls given its greater earnings visibility in the near term as they continue to show resilience. We also have a positive view on hospitality REITs, as this sector is poised to actually enjoy robust earnings growth over the next 2 years as borders reopen and global travel gain more momentum. So the left chart shows occupancy levels had actually bounced back to pre-COVID level, although there is a clear divergence. So unsurprisingly, US and Europe is actually well ahead, and this is largely due to looser border controls, whereas the other parts of the world is actually lagging behind. Nevertheless, we see upside as ASEAN and Oceania actually catch up. So in Singapore itself, the tourism industry is seeing a gradual recovery, thanks in part to a concerted push by the government. Tourist arrivals are steadily increasing, and the government actually aims to boost air passenger volume at Changi Airport to 50% of pre-COVID by year-end. So in Singapore itself, the hospitality as REITs are relatively resilient because a good proportion of their rents, up to 70 to 80%, are actually fixed rents. So these provide a very good buffer against adverse downturn. We also see good opportunities for Japan hospitality REITs. Now, tourism in Japan is quite an important part. They contribute up to 7% of GDP back in 2019. So there is good demand from domestic travel supporting the industry currently, as Japan's borders have not quite reopened to foreign tourists. And just to give you a sense, the right chart shows inbound tourists into Japan, and that is 32 million back in 2019, whereas year to date, the country has only recorded less than 2 million arrivals. A full border reopening coupled with the weak yen currently should actually provide a kicker to the sector. So where do we see greatest opportunities and where is relative value? The reopening theme so far is playing out as expected, and we expect this to actually remain a focus in the near to mid-term. And while there is evidence that certain segments of the REIT sector is poised to actually enjoy further earnings recovery, we expect this to be tempered by macro concerns as well as a slowing GDP growth. As such, we would actually advocate for a barbell approach, and we think industrial REITs will be most resilient in this environment, and they are actually a core holding for defensiveness, given that sector fundamentals are still very strong. And we prefer industrial REITs with good valuation support. We also like office REITs, as this sector is a good proxy to play the recovery of the broader economy, even though this is a two-tier market. For office REITs itself, we are selectively positive on certain office REITs, especially the downtown or central located grade A office buildings, as they have continued to actually show resilience on the back of continued flight to quality trend. And for retail REITs itself, our preference is actually for suburban or neighborhood retail formats, as they remain quite resilient. Having said that, we think that the return of tourists as well as the limited new supply will actually support prime and downtown retail recovery. Likewise, we are fairly bullish on hospitality REITs. This sector is poised to enjoy robust earnings growth for the next 2 years. And the key catalyst for this sector is the resumption of China outbound travel. We also think that hospitality REITs have actually been more proactive in the last 2 years, and those REITs which actually expanded into new business models such as your student accommodation or your longer stay duration types will be more resilient. So these are some of the key investment themes we have identified and embedded into our fund. And one of them is e-commerce beneficiaries. For this, we like logistics REITs with wide geographical footprints, as they should see greatest benefit as tenant stickiness is likely to be higher. We also like REITs with resilient assets. Quality assets like your data centers is fairly resilient given the secular growth. And one of the main investment criteria we pay attention to is how defensive a REIT is. As such, we have a preference for REITs with high built-in rental escalation, either through CPI link or through annual escalation built into the leases. And lastly, we like REITs with growth capabilities. This can be either through organic or through asset acquisitions. I would like to leave you with 4 key takeaways today. Then the first one is APAC REITs is a good investment tool for regular income, especially given current market uncertainties. An average dividend yield of 4.3% is still fairly attractive. And secondly, valuation is compelling at current levels. On a price-to-book basis, the sector is trading below mean levels and thus would provide a good buffer against downside risks. And third, dividend growth trend is expected to continue, and we expect dividends to grow by 4.3% per annum over the next 2 years. And lastly, while interest rate is a headwind, there are mitigating factors, and going forward, we expect the uplift in rents as economic activities normalize and abatement in rental waivers to continue to drive sector earnings. So these, along with the past acquisitions, will ultimately translate into higher dividends for shareholders. This concludes my presentation for today.